2025 is just around the corner, and there's been a lot of buzz about the Federal Reserve's recent interest rate cuts. But let's be honest, these cuts might not have as much of an impact on mortgage rates as we hoped. At the start of 2024, it seemed like we were on track for lower mortgage rates. Inflation was expected to cool, and the Fed was signaling multiple rate cuts, which would ideally make borrowing more affordable. Fast forward to now, and it's not quite going as planned. Mortgage rates have dropped a bit from 2023 peaks, sitting between 6.5% and 7.5%. Experts had predicted rates would dip to around 6% by the end of 2024, and even into the mid-5 range by 2025. Instead, rates recently spiked back to 7%, leaving many economists scrambling to revise their forecasts. Looking ahead to 2025, most projections show 30-year fixed rates holding steady in the mid-6 range. That's a far cry from pandemic-era lows of 3%, so why isn't the drop happening? It all comes down to a few factors. Mortgage rates are tied to the 10-year Treasury yield, which fluctuates based on inflation expectations, economic uncertainty, and policy changes. Even small shifts in these areas can influence mortgage rates. And let's talk about affordability. Home prices have risen more than 40% since 2020. And while price growth is slowing, inventory remains tight. Many homeowners are sticking with their low-interest mortgages, freezing the market in what's known as the rate lock effect. On top of that, a shortage of new construction is keeping supply low. So while lower rates in 2025 are possible, they're dependent on inflation easing, slower job growth, and lower bond yields. Without these changes, rates likely won't dip much below 6%, keeping home ownership out of the reach for many families. And 2025 is shaping up to be just as unpredictable as the past few years. Mortgage rates might drop slightly, but the real challenge of affordability will remain a major hurdle for home buyers.